I got an email from an old friend who was about 9 years from retirement. He was talking about stepping out of the market because he wanted to protect as much of his principal as he could going into retirement, and he was thinking about buying gold and silver. And I thought, why? Of course, his first question, well, a lot of it is because of fears of things going on in the world, the direction of things going on around the world. A lot of scary stuff happening in the world, really, right now, if you think about it. There always kind of has been a lot of scary stuff going on in the world through the past century, really. But of course, his fears, if you think about it, become really heightened when you're getting ready to go into retirement. So I thought, why not talk a little bit about just really basically what is investing? What is it? When I invest, for example, in gold and silver, that is not investing. Because what I'm doing is I'm actually speculating because the growth or the decline of those metals is due to supply and demand. Investing by definition has to be somebody using my money and paying me for the use of that money. Now, they'll pay me varying amounts based on the amount of risk or the volatility that might be involved with that investment. For example, let's say I go out to my local bank and the bank tells me that they'll pay me 1% on my money. That, of course, means that they're going to pay me $1 for every $100 that I invest. Now, one of the problems that you can run into with this particular scenario is that if I invest in my bank or I invest in government bonds or corporate bonds or whatever, all that entity is doing is agreeing to pay me back in the same currency that I gave them. So if I give them dollars, of course, what are they going to pay me back in? Dollars. If I pull out a $100 bill and I say, hey, what is this? It's a $100 bill. What's it buy? $100 worth of stuff. Why? Because we all agree. It has its value based on our agreement that it has value. It's kind of precarious if you really think about it. If you go back through history and you look at collapses of countries around the world where they've had economic collapses, calamities, it has always been the fixed income investor that lost everything because the value of their currency went down precipitously. So that's one of the things you got to watch out. You don't want to have all your money in fixed income investments for that reason. Who is it that comes out okay during those types of collapses? Well, it's property owners, people that own property or companies. And if you think about it, when you invest in the stock market, you actually own companies that own land and buildings and machinery and equipment and those types of things. Now, where's the cost of capital with a company? Where the cost of capital is of course, I get the earnings of those companies going forward. Now, if we look at what the earnings are, you've got your earnings of a company and you've got your price that you pay for those earnings. We call that the earnings yield concept. And one of the better ways to look at this thing is look at forward earnings, what we expect earnings to be in the future with all that bad news factored in. What do we expect the earnings to be? And what we find if we look around the world, that number is anywhere from about $1 of earnings expected for anywhere from $8 to about $14 if you look at various areas of the stock market going forward. So if you look at that, you say, wow, you know what? Owning stocks, the expected return is much higher because I'm getting more for every dollar that I invest. But there is volatility in the market, and that's why you still want to own both. It's kind of like Solomon said, put your money in 7 or 8 places because you don't know what kind of calamity may come upon the earth. And he was a pretty wise guy. So hope that helps, and we'll catch you next time.